Hi everyone, welcome to JEDi episode 14. My name is Jimmy, and with me today are Ethan, David, and our special guest, Luke. For those of you who tune into our Facebook Live for the first time, and if you want to know more about us and the name JEDi, do check out our first episode in the video section. I'll be the moderator for this episode, so here's how we're going to run through. We will first address questions that were raised during the previous episode. Then Ethan and David will be having a fireside chat on investments part 3. And then Luke will cover the bonus section on the value of financial advisors. Then last but not least, we'll have a Q&A section. So feel free to post your questions in the comment section below, and we'll address them during the Q&A section. So without further ado, we'll move on to the questions raised during the previous episode. I'll let Ethan start the ball rolling. Ethan?
Okay, hi everyone. I'm Ethan, the founder of PolicyWoke. So we did have a Q&A from the last episode. It was a very long comment, but this is what we have seen. We tried to summarize it. So this is actually what he asked. How much should he trust a new financial advisor he has just met? So he gave a few guiding questions like, is it wrong to check the facts? Should the financial advisor guide me to understand what he have just said? Or should the advisor ask me to fact check what they say? Yeah, so anyone wants to take this first?
Okay, so I think generally, right, it's you can trust someone as much as you want to trust someone. So it's never wrong to check anything. It's actually advisable to check because especially when it's something that is not in your domain, you want to know more, you should check. And should the person help you to understand? Yeah, definitely. But should the person ask you to check what they said? Why not? I mean, it's perfectly reasonable if I explain to you and I also want you to check yourself to make sure that whatever I said is real, is not just made up.
Yeah, Jimmy?
Well, I mean, I do have my own servicing financial advisors that I've been in contact with. So whether you can have a long-term working relationship with the financial advisors, one of the important factor is the trust that you have with the advisors. So I mean, as long as you can continue to trust your own servicing financial advisors, then all these questions should be a very small issue. So I mean, personally, I'm good so far. Yeah,
okay.
That's all I can say. Yeah.
Okay, so Luke, you want to say something? I don't know.
No, I mean, it's quite cute. That's why I was laughing. Of course, it's good to check your facts, and obviously, especially like when you speak to a consultant, they better have some way to guide you to understand whatever the heck it is they're talking about if you're not sure. So that's why it's very funny that the question has to be asked at all. That being said, you also want to kind of establish, for example, with the consultant where you're getting your fact checks from, and kind of establish a certain ground for the relationship. So if someone was asking this kind of question, and as a FA he has certain expectations, he should kind of tell me, okay, listen, like I'm gonna go back and check through some of these things for myself or verify some of this information which you've spoken to me about, just to be sure that I'm very clear about what you're talking about, as well as what kind of service you're offering me. And then I should share with you in a very like a very civilized, open, honest discussion about these are the things which I understood from the fact checking that I did, and what do you have to say to that, because the problem with some of this fact checking is that you can fact check wrongly, frankly speaking, and it can go very disastrously for both of you if you don't know where to fact check from for the most part, most of us aren't equipped with the financial skill set, so we don't know what we don't know. So if you're fact checking something on your own when you have no financial knowledge on how to do fact checking, usually you come to a couple of wrong conclusions, and so that needs to be discussed very openly with your financial advisor after that.
Okay, personally for me, honestly speaking, I don't think we should trust any new people that we just met. I mean, that's a fact. No matter how good you think the person is, so it is always right to check the facts. And okay, of course, you need to understand the parameters of the facts. Facts can also be miscontextualized to a way. It's like a straw man's argument, if you understand what I'm trying to say, a straw man. So he's going to go to an extreme end, say that this is absolutely wrong and nobody should agree with this. That is one way that they may present the facts. But life most of the time is at the gray area. So I would say that just check. You won't lose an arm and leg to just check. And for the financial advisor, if he has a bit of incentive, right? I hope that he will guide me to the correct understanding and not the wrong understanding, definitely. But because of the experiences I have with financial advisors, personally for me, I went to educate myself further. So that is where I understand what is they call it time value of money. How should you balance between time value of money with absolute returns without checking the time value of money and plenty of other stuff. So it really depends on what is your belief and how you actually look at it mathematically. Because even statistics can lie if it's presented in a very skewed way. Yeah. So I tend to look at everything. So you can have three, in fact, for financial advice, you can have three FAs telling you the same thing, but in three different forms. One can be extremely positive, one can be on a very neutral stand, one can be on a negative stand. Because there's no context.
Sure.
Yeah. So I would say just check.
I mean, I would argue that you will have to draw a line for yourself somewhere because most decisions are still based on trust. So, I mean, the problem with people who do this, if they don't have your level of experience, is that they become haunted by decision paralysis, which is something that we see in the industry all the time. And it's probably a pretty decent reason as to why the majority of people today are severely underinsured for something like critical illness, despite all the screaming on social media about critical illness changes now. So those are things that basically it's pretty hard to fact check when you don't know what you don't know. I think that in order for you to, I still do think that if you insist on fact checking, you should be able to kind of show that you have a certain degree of understanding of these things. Yeah, because as a human being, it's not efficient to attempt to have that certain level of expertise for yourself if it's not in your area of interest or you don't have the time. This is especially applicable usually I find in older people or like middle management executives in their 40s. Very, very unlikely that they're going to be able to have the time to fact check this particular degree without a certain significant amount of opportunity cost. So just draw a line and then you'll be fine. I'm not saying you shouldn't fact check, I'm just saying that yes, you have to fact check in a very methodical manner and with a plan in mind. Yeah, and a line as to where, okay, like this is the amount that I fact checked already, and then I have to take a certain degree of trust at the point.
Sure, yeah. That's the way to move forward because nobody knows everything. That's definitely. So that's for this. So let's go to the table of contents today. So we're talking about just investments already. The most basic unit trusts, mutual funds, ETFs, and what we think about low fees and high fees. So what is unit trust? So look at the diagram. It just shows one big block is a trust. On the right side, there are units. So basically, just cutting the trust into a few very small pieces and sell it out. Imagine you have You bought wholesale from maybe the supermarket, one big carton of hot dogs. Then you pack it into 10 hot dogs each, then you just sell it off. So that's how you get to be participating in the trust. So the strategy for the unit trust also depends on the fund manager, and it's all on the fact sheet. So to sum it up, unit trust is actually like a big pool of investment products, and it's packaged to various small packs. So everyone just buy a small pack. If you want more, you buy more packs. And it's managed by a fund manager or a trust manager in this case. Okay, so what is exchange traded funds? Okay, they are actually funds that is listed on the exchange and traded. So that's why I call exchange traded funds, as the name implies. But more commonly is tagged as for most people index funds, but there is no index funds. So they are called index mirroring funds. And they are also more commonly tagged as passive. But to take a big note, ETFs can be non-index and non-passive depending on the fund itself. But broadly speaking, it's more known to be low cost and passively tracked. And this is the commonalities and differences between ETF and unit trust. So what is common is they are also as small units, and you can buy as many units as you want. Most of them are diversified usually, but diversification also depends whether it's geographically diversified, whether it's industry diversified, or even companies diversified. It can be all the companies in the energy or all the companies in oil, and it's commonly allowed for retail access. But the differences are the name, that's very obvious, the fact sheet of each ETF and each trust, because they really go into what they want to invest in. And usually ETF is more low cost because they are more passive. They just buy and don't really sell much. Okay, so for low fees and high fees, this is what we think. Low fees, if you are looking for low fees, you should be looking as passive as possible. And you should be working just for slightly below market returns. You can never get market returns because you are going to mirror the market. And with some tracking error, they call it, or with some timing error, some other error, it definitely be lower, slightly lower than market. But if you're looking at high fees, most of the time you'll be looking to beat the market. And track record is important. Yeah. So today we are going to talk about the value of financial advisor, and what should we expect from a financial advisor? Yeah.
Okay. What should you expect from a financial advisor? Just primarily in relation to investing, or
it can be anything.
I mean, you want, first of all, someone who can explain financial products and concepts to you in a very easy to understand, relatable manner. And then obviously they should be correct. And then they should be able to make suitable recommendations according to the kind of financial needs that they anticipate in your life based on a very thorough discussion. Yeah. So, and then obviously after that, if you purchase something that both of you, especially obviously the client, believe is according to those needs, and they can make that kind of commitment and they understand the weight of that commitment, then there should be a degree of servicing where you can turn to the financial advisor for various things, both administratively as well as accountability, basically. Like how advisors will usually coach you through particularly turbulent times in investments, or whether or not they should heads up you for certain life events, if there are any special things going on that may optimize the current portfolio that these advisors are aware of. Because, in other words, the advisor should be reaching out to you some of the time if he believes there's an opportunity for you to maximize your portfolio more efficiently, and they should be around for. They don't have an obligation, but I believe, personally, not sure about the rest of the standard, that you should be around for claims. That's pretty important. and all sorts of other follow-up servicing stuff such as nominations. That's what I think you should expect from
Sure.
an FA lah, because you pay a pretty sweet sum of money.
Okay. Then should I expect more from a financial advisor? Like for example, let's say, should they be well versed in cryptocurrency, alternative investments such as gold, commodities, even forex options trading, whatever? Should we expect that?
I would my default answer is no, to be fair. But the fact that if you get something like this and you're not expecting it is usually a plus, right? Because that will tell you quite a bit about the consultant or the advisor in question. Most advisors, if they are very intimately involved with this career, they will learn a lot of other things that surround beyond the products that they're offering. Yeah. So an advisor who can not only discuss such things such as commodities or crypto, but if they can also discuss, for example, their competitors or familiar competitors from products that they don't know about. Obviously, we're not in a position to badmouth that according to MES regulations, but they should at least have awareness. So, for example, I'm very aware of Scythe's fairly aggressive marketing currently,
Okay.
and that was as a robo advisor / bionic advisor. I'm aware of people like Money Owl who do basically the same job I do, except that they position themselves as salary-based advisors, and they should be able to. I don't think anyone should really expect this because it requires quite a lot of time and commitment. But it's always a plus if your advisor has at least a broad understanding of some of these things, because as a consumer, you actually look at a much more broad picture than just the advisor's products. So it's good to have an advisor who can do those things, but realistically, for the expertise and the specialty, you usually wouldn't expect them to know these things.
So am I right to say that if I'm looking for,
So
yeah, maybe come. Yep.
so does it mean that you can engage both a financial advisor and also a hedge fund manager?
As a consumer, like as a consumer, like can you engage both a hedge fund?
Like as a overall general financial planning, can you engage both financial advisor and also a hedge fund trader?
Rarely in Singapore in particular do people engage hedge fund managers, and then usually it will be purely for the purposes of investing with a very specific intention in mind. Either that or you get prospected to. So hedge fund managers are primarily limited to so-called investing, although obviously as hedge fund managers they have a much wider range of control of how they control their own investment. So it's really comparing very apples and oranges kind of thing. But as the consumer, frankly speaking, you can do whatever you want, right? Like you can approach a hedge fund manager for investments, and then you can talk to a financial advisor who may also do investments, but the scope can be very different. And then you may want to approach someone who is more in the crypto space, who understands all the stuff to do with blockchain and wallets and all that. As a consumer, you approach everybody, whoever you want to, whenever you feel like it. You know what I mean? That's your right as a consumer. And so it would be good if financial advisors understood that. Whether or not you can expect it is a totally different story.
Okay, so for fees and returns, what are your views? Like, yeah, we previously talked about the lower fees and higher fees. So I believe you have something else. So yeah, maybe you can share.
Well, I mean, the FA's job is they will charge you a fee based on whatever service they provide to you in their capacity as a financial advisor. And realistically, if you engage an advisor, your fee will probably be higher than that of, for example, a DIY instrument such as a POSB Invest Saver, where you can invest into something like the Straits Times Index exchange traded fund. Because it's two different services. One is that you run through a financial advisor like myself who can do some of the things that I mentioned before. And then one is that you're basically investing it on your own through a platform that doesn't really that you don't really have anyone to accompany you for whatever reason, or to kind of guide you through the product that you're investing in, so on and so forth. So it can be quite different, but as a general rule, if you engage a third party or advisor, you will likely pay higher fees. So that's quite I think that's quite objective.
Yeah, I remember you spoke about there was this fund that is actually less volatile than S&P, but it slightly underperforms S&P. Maybe you want to elaborate on that more?
Oh no, because the last time we spoke, I was talking about the H&F fund and fund, which was actually like a kind of like a growth hedge fund that was benchmarked against the S&P 500. So if y'all didn't know, a lot of mutual funds in the US or even hedge funds are benchmarked against S&P 500 as US growth, and usually they lose lot. Like it's not very difficult to verify this online, especially if you look at research studies such as the Standard and Poor indices versus active. So I was discussing the last time we spoke that this particular fund lost, which is not exactly a big surprise. It was doing about 7.6% in 20 or 30 year period, I remember, versus the S&P 500's 9. Now, what made this fund so interesting, or why it seemed so valuable to me as a consumer, personally, as well as in the purposes of my research, is that the volatility for the S&P 500 during that particular period was about 14 or 15%. And as we understand it, volatility usually refers to your risk. Yeah. Again, this is something that's very verifiable online. While the volatility on this particular fund, on the other hand, was about 2.5% compared to the volatility of about 14 or 15. And the repercussions for this are tremendous, because what you see is basically the S&P 500 will make an up and down jagged line at certain points, while this particular fund is almost completely linear if you look at that kind of very minimal volatility. And this, even though the underperformance overall, meaning that, for example, if you had held the S&P 500 for 30 years, you have done 9, and if you held that fund for 30 years, you have done like 7.6. But if you had come into it at any point in between that particular point, it would technically, by a lot of probability and statistical measures, be easier to sell that particular fund for a profit than the S&P 500. That is how we do risk management as investment specialists, or financial consultants who happen to be very into the investment space. Yeah. So you can see that there's still a very huge, tremendous value in a fund that has completely on paper lost to the S&P 500 in terms of returns. Yeah. Because ultimately it's about when you sell, right? As well as, of course, in relation to the various age markets which can handle different amounts of risk tolerance.
Okay, sure. Thank you. Yeah, I think we'll skip that question. I think this is more what we everyone want to hear. So, what is the most atrocious comment you have heard from your clients? You can have a few. Yeah.
I mean, the last time I spoke about, usually they will reject ILPs outright because they've heard fairly atrocious things about it. I think recently, someone. I mean,
Oops.
Did we lost Luke?
Sorry.
Yeah, I think we lost you for a moment.
No, I was saying the other one that I get aside from negative comments about ILPs is that that sometimes people will say that like whole life plans are scam.
Okay.
Yeah, did everyone hear that? Sorry.
Yeah.
Yeah, so that is a pretty negative comment that is a little hard to deal with. I'm not. I mean, this was actually a little popularized by Suze Osmond, who's actually very famous in the Buyer Independence Retire Early space. So she actually made this comment and it went pretty viral. And I think a lot of fee-based advisors, a lot of fee-based advisors tend to take this as reality, even though I think the industry has evolved quite a lot in the last few years, where whole life is starting to cater to a wider range of options than just, for example, legacy. So people who are very into that kind of space, or who tend to lean towards ideologies rather than checking out numbers for themselves, they would give me a pretty hard time, because I can use numbers sometimes to verify or to kind of what's that called? The word for it is to justify like a recommendation. But some of these people wouldn't even be open to discussing it because their idea of financial planning is based on an ideologue and not a numbers reality, which it should be. So I think that anyone who is reasonably in the financial space, whether or not you're a financial advisor or a consumer, needs to understand that this is a very fast changing space, especially with the addition of fintech. And so ultimately, in addition to, of course, advisory, which is the interpersonal connection, if you're really insistent on doing some things on your own, right, math is your best friend. Very simple. Yeah. Doesn't matter what kind of ideologues you have. Ultimately, you need to check your math. And every couple of years, sometimes this math changes.
Okay. So am I right to say that it doesn't matter what kind of products that we have, but it's more about how it can actually fits into your goals or what you are trying to do basically.
A little bit, sure, but you also have to discuss whether or not it's cost efficient for you that to go into your goals. So if my goal is to buy like a car that can transport me to around the country, for example, then my standard would be depending on whether any kind of car will do that. Yeah. So I would make the decision depending on what kind of person I am. The need is to travel around the country, but as a person, like, do I care or not whether the car is a Mercedes, or can I just settle for one of those cute little hybrid cars with a lot of mileage, which are a lot cheaper. So the general idea is there. So just because you have a needs-based recommendation, and just because you have certain of your own ideologues, all that stuff doesn't matter until you do the math. I mean, not say it doesn't matter entirely, but there's a need, and then the math needs to justify the meeting of that need above everything else. That much I can say quite
Okay. Thank you. So at the finish we discussed earlier on like what angles and questions are for financial advisors to answer. So do you really consider yourself a risk manager in this case?
The primary, I mean, I guess some people will use like risk manager to make their job description sound pretty cool. But ultimately, I'm a financial consultant and insurance agent. That being said, a lot of my job does seem to revolve around risk management. Whether or not it's in investments or insurance, it just feels like that's all I do. So I guess that would be fair. I'm not sure if that's something that can be used as an official designation, but I would say yes. My answer would be yes.
Okay, the reason why we had this question was because we actually met a business insurance consultant, and the way that they are talking about, especially for businesses, right? And when they're consulting their CEOs, CFOs, they are really talking about the risk of a company, why they require all this to manage the downside.
Yeah.
So that was why I actually asked you, do you consider yourself a risk manager? So
Yeah, sure.
I think it's pretty fair because risk management in operations is different from in financial services, which is also different from if you are in a hospital, because the risk you make is different. It's
Yeah,
really
that's why I
based.
wasn't sure. Yeah.
Yeah, so that's why I think everyone can be a risk manager in their respective field.
Yeah.
Yeah, but more so when, especially when
If you're doing investments, you can also be a risk manager.
Yeah, very much.
For investments purposes. You can also plan your risk.
Yeah, so that's why I think we talk a lot about risk reward also in the few previous episodes. So for what about your views, Steve? What do you think of the risk and rewards? So how would you balance your risk and reward in this case?
Oh, I mean, we can just roll into an opinion section here because this is not financial advice. But my risk reward threshold is totally screwed, man. I'm all risk, all reward. So basically, the context of that is that we look at like like a measure like the Sharpe ratio, right? Okay, so the S&P 500 has a Sharpe ratio of usually about 0.9, which means that it makes an additional of that amount per percentage of risk taken. Yeah. So the absolute return, based on historical performance S&P 500 is maybe like 9 or something, or 10, right? What I do is I invest in something with like a Sharpe ratio of like 0.3, like personally. Yeah. So you can see that this excess risk, this excess return on risk is like almost non-existent. Yeah. But my absolute returns or my absolute projected returns are closer to about 15. Yeah. And that's on the basis that I have to knock this investment for at least the next 25 years. Then hopefully some of the dollar cost averaging will knock that out as well. Yeah, but that's my stance currently. Yeah, so that I can get a much higher absolute return, even though the risk management there is a bit bonkers, but that's because I have a time horizon. So for every individual client, it has to be different. But in my case, that's how I do things currently for myself.
Are you talking about options here?
No, I'm not. Just hyper aggressive funds, which even the ETF versions usually, is if you look at concentrated highest risk, single sector, single geography kinds of funds or ETFs that will allow you to kind of take that kind of absolute risk and absolute return. The Sharpe ratios are almost non-existent, but you can achieve, or based on historical returns, you can achieve much higher absolute amounts than something generic like the S&P 500, which is why when you talk to a financial advisor about things like this, hopefully if they claim to be investment specialists, they should be able to understand things like this so that you can see that you have a much wider range of options than you actually believe. And of course, it's a plus if they know things like what you just mentioned, options trading, forex, crypto, gold, silver, the standard stuff. Yeah. But for
Are you
myself
exposed
personally,
to
sorry?
are you exposed to like private equities or not? Will you invest in private equities then?
If private equity counts like my land in Thailand, for example,
Yeah, maybe.
yeah, sure, then I guess it's a bit late to pull out now, man. Like that's a really risky investment for sure. Yeah. Because I have some land in Thailand, which is yeah.
So what's the issue with the land in Thailand? Yeah, maybe you want to share a bit more, maybe.
Well,
It's in
so
Thailand.
yeah, that's one. Thanks. Like automatically that added on. Then of course for any standard investment, you will still, regardless of the actual risk of it, it will be like the forex risk, for example. And of course whether it's subject to like natural disasters, things like that. Those are usually things that we won't experience if you're investing through like Singapore and SGD. I mean, uh, I think the some of the recent risks, for example, was building a house on that land. So my girlfriend was supposed to make a door lah. So basically she was supposed to attach a door to the house, yeah. But because of COVID, they were delaying the delivery of this. They're supposed to slice a hole into the house and then make a door shape, yeah. And then they couldn't come in time, so she got impatient and she called me one day and she said, "Hey, I'm gonna slice a hole into the side of this house so that I can have a door." And then obviously I said, "No, please do not do this because you will hurt yourself and it's really dangerous." Like my girlfriend is like not even 146 cm, so like she's just like this small girl, and then she's like carrying this like
Maybe
large
she has a
blowtorch
sledgehammer.
thing. And what the I don't know what the hell, how the hell like she went through with it lah. But in a nutshell, of course, like most girlfriends, she just basically didn't listen to me. And then 2 days later, she showed me a picture of the door. Yeah. So I was like, okay, this door seems pretty legit, and you didn't hurt yourself, so thank goodness. The door person finally shows up, and he's like, "Oh, okay, you slice the door open for me." Obviously, she did this in the interest of saving money lah. Then he realizes that he cannot attach a door to it. Right? He can't attach the door to it because the measurements are wrong. And then he cannot adjust the door in the house because it'll compromise the entire integrity of the house or the structural integrity of the house. So those are some basic risks from just having something stupid like land or building your own house into like somewhere like Thailand, right? And so he tells her that, okay, I'm going to go back and build a door according to these wrong measurements. So he goes and measures the incorrect door, and then he goes back and then he customizes like a door that is also wrong in the wrong measurements so that it will fit into my house with the wrong measurements. And it costs 3 times as much as what it would have cost if she had just left the guy to drill his stupid door. Yeah, okay. And that's and that's private equity risk in a nutshell. Yeah, so irritating. Yeah, so I was pretty upset with her, but thankfully it was not a big amount of money in hindsight. I mean, 3 times of something that's not very expensive is still not very expensive, but it did,
It's
like, these
Thailand.
little things
Everything is
pop
20,
up
20
quite a
times
lot.
cheaper.
Thankfully lah. Yeah. But these are some of the basic risks that pop out, and they kind of sneak up on you a little bit. So a lot of these little fees start to add up. Personally, for myself, if you've seen my article on moneymaverickofficial.com, where I was writing about how I've lost like 17% dating my girlfriend in the last 3 years because the Thai baht has appreciated from 26 when I was dating her at the time to about 22. So I'm getting killed basically in terms of SGD. So those are little risks you'll have in private equity, especially overseas as well.
Mm.
Yeah, so maybe one last final question in view of the time. Maybe can just tell us if people want to look for you, what should they be looking for you? What's your expertise, specialty? Yeah.
Oh, that's nice. So nice of you to include the section. Okay. I guess I have quite a bit of experience in this line now. I consider myself a critical illness and investment specialist. So if you look at my blog, which is also rated by feedspot.co as one of the top 20 investment and finance blogs in the country, you'll see that I have a decent range of expertise in this particular specialty. And if that is what you're looking for, then you should find me. That being said, even if you're not looking for such things, usually I think you can see that the amount of research that I put in for such topics is quite meticulous, and that usually I will serve you fairly objectively. If I've handled this interview objectively, then I'll generally serve you quite objectively. So hopefully that is why you'll look for me. I'm generally quite readily available as well. I barely take any holidays. I don't really have much of a life. I don't have any hobbies. I rarely fall sick, so you can always find me.
Yeah. So Jimmy, I think we are going to the last few sessions. Yeah. So maybe you want to see if there's any questions.
Okay, Ken. Thanks, Ethan, David, and Luke for the fireside chat and the bonus. We hope you find it valuable for your own investments. So we'll now go for the Q&A section. So now is the time to post your questions in the comments, and we are now addressing them. Okay, so we have one question from Julian. So his comment was just not volatile. Just 2 words, not volatile. So not sure which asset class he's referring to. Was there a particular instrument that you all mentioned that is not volatile? Can you all recall?
I mean the fund in fund was probably not very volatile.
Fund. Okay, right.
Oh, you mean like the S&P 500 or the HNF?
Yeah, the HNF
I mean,
fund in fund.
Volatility is relative. I mean, if you are looking at something that is stable, not volatile. Some people say, CPF is not volatile.
Yeah.
Some people say that STI is not volatile, or even the SPY is not volatile. Yeah, I mean, if you compare with, say, like gold or crypto or whatever, then yeah, definitely it's not volatile. But you have to see what's the angle you're coming from.
That's true.
Sometimes volatility is good because you can trade it, but sometimes volatility is bad because you can't rely on it too much. If you're in retirement mode, you don't want to be volatile. You want to be stable.
Okay. Anything to add?
No.
Okay, that's all the questions so far. Any questions from your side, Ethan? The story you shared?
No.
No. Okay. So if there's no more questions, then we are going to end this episode. So those of you who have tuned in, thank you for tuning in. But this video will remain in our Facebook account. So if you still have any questions with regards to investments and the value of financial advisors, feel free to post them in the comments, and we will address them during the next episode. Okay, so as we move on to the last slide, okay, so now is the last slide. So this is a QR code whereby if you scan the QR code, you have access to the links to our social channel. All right, so you can find our website, Facebook, YouTube, and our Telegram channel. So the Telegram channel is where you'll find more details about the resale insurance policies that we have. So if you want to know more about these insurance policies, do reach out to us via Telegram. Yeah, and we'll be in touch with you. Okay. So speaking of the next episode, join us next Friday, 5 p.m. for JEDi episode 15 on investments part 4. If you like our content and be notified for future episodes, do like our Facebook page and share this Facebook Live. We will see you next Friday, and may the
finances be with you.
Okay, goodbye.
Thank you. Bye.
Thank you, Luke. Bye.